Hello everyone, welcome to my channel. In this video, we will discuss evolution of money, which is driven by trading needs. Money evolution is a vast and a fascinating journey. Through learning money history, we can trace the evolution of how humans exchange goods and service. From the overview here, you can see humans went through a long history of money involvement. In prehistoric time, humans exchanged goods and services in a gift economy, where goods and services are given without the expectation of immediate or even future return of compensation. In early school relationship is an example of a gift economy. For example, if Lily has two pieces of candy in her pocket and she gives one piece of her candy to Sarah without expecting Sarah to give her anything in return. This type of relationship creates social connection and well-being. Whether the society development, human skills were more specialized. The earliest form of trading, which is bartering, was developed where people directly exchange goods and their service. As society become a more complex, bartering system become cumbersome, leading to the use of commodity money. These were items like shells, salt, livestock, or precious metals that everyone agreed that had a value and it could be exchanged for other goods. With the further development of a society, the use of minted coins simplified the transactions by providing a standardized form of a currency. It, like Chinese introduced the paper money eventually. As international trading become more frequent, digital money platform significantly increases the efficiency of international trading and fundamentally changed the trading landscape. We currently developing cryptocurrency is an even more sophisticated digital technology. We will expand each type of money in the following slides. The earliest form, in my opinion, is the barter system. It is considered as the dawn of trade. In early civilizations, people exchanged the goods and the service directly based on mutual needs. In this system, no intermediary is used. For example, gorilla has 5 pounds of a banana while monkey has 5 pounds of a wheat. In the meantime, gorilla wants wheat while monkey wants banana. So gorilla gave his 5 pounds of a banana to monkey for his 5 pounds of a wheat. As you already say in this system, for the trade to happen, gorilla must have the desire for wheat, while monkey has to have the desire for banana. Without the desire of either one, the trade would not happen. And both of them assumes that a banana and a wheat is the same price, which may not be true as we can say in the current market. So there is inherent disadvantage in the barter system. It is challenging to find a compatible trading partner and determine the fair value. In the meantime, transportation scalability restricts the development of this form of a trading system. So humans developed another system called commodity money as a more efficient medium, which in my opinion is the origin of trading using intermediate. During this time, valuable goods merged as a more efficient medium of exchange. It can be agricultural goods like cattle, grain, or precious metals like gold and silver. or animal products like elephant tusks or even cowrie shells. To be used as commodity money, the goods has to meet several criteria. It must have intrinsic value, which means it must has value even without being used as a trading intermediate. The value of the goods has to be stable, which means its value cannot be easily manipulated by anyone, including government. In addition, it has to be durable and resistant to wear and tear, maintain its value over time. It also needs to be portable and divisible. The adoption of commodity money addressed the limitation of bartering, such as the need for a double coincidence of wants. While commodity money has some advantage, it has its limitations, such as difficulty in transportation, storage, needed to the development of another system called coinage and paper money. Coin and paper money are more efficient monetary systems. The early form of a paper money is representative money, where paper money is backed by a valuable commodity like gold or silver. Another example is the food voucher in China during 1950s to 1990s. For example, if gold is $100 per gram, when bank gave you 100 paper money, theoretically they must have a 1 gram of gold stored up in the bank, and it is redeemable for you upon demand. Over time, as economies evolve and the practicalities of a commodity-backed system represented challenges, like limiting the money supply. Many countries transitioned to fiat money systems. Fiat money, which is the current monetary system in most countries, is not backed by a physical commodity, and its value is drives the public's. It's driven by the public's trust in the issuing government and the public's confidence in the stability of its economy. In a fiat monetary system, money has no intrinsic values. Central banks appointed by government controls the supply of fiat money. Central banks have more control over the economy. The use of monetary policy tools like interest rate to influence the supply of money and manages the inflation and the deflation of the economy. Though fiat money provides flexibility and convenience to the current trading system, it has disadvantages. If the central banks print excessive money, it can lead to inflation and the value of money decreases. Like we mentioned earlier, it relies on trust, which also makes the economy system susceptible to crisis. For example, if last month there's only $100 of fiat money on the market, and there's also 100 pounds of beef on the market for trading, then the price of the beef will be $1 per pound. But if the central bank printed 400 additional monies on the market where there's still only 100 pounds of beef on the market, so now there's a 500 of the paper money on the market to trade for 100 pounds of beef, then the price of the beef will become $5 a pound. This is called inflation. Ultimately, fiat money is backed by trust, and the public trusts that the central bank will make the right decision on the monetary policies. Then with the globalization, the demand for long distance or cross-region transaction was significantly increased. The development of digital money made the cross-region transaction more efficient. Digital money is the digital version of a country's fiat money. Same as the fiat money, it is issued and regulated by the central bank, but it is operated electronically through digital form. For example, Lily buys $50 of bread from Sarah. Instead of paying Sarah the $50 of cash from her pocket, she transfers $50 from her bank account to Sarah's bank account. Then Sarah can either spend that money through online payment or redeem the $50 cash from her bank to put in her pocket. So digital money exists in bank accounts as a number. This monetary system is a shift from physical paper money to an electronic form. It is accessed through computer system over internet. Another form of a digital money is currently under development called cryptocurrency. It's similar but different from digital money. So the difference from a digital currency exists only electronically and operates independently from a central bank of a government. Cryptocurrency, like a Bitcoin, don't actually exist in any form of a coin. We can't get a Bitcoin even upon demand. You can only be exchanged to fiat money in certain exchange platforms like Coinbase. In other words, cryptocurrencies have no intrinsic value. Their price is determined by market demand and the quality of their underlying technology. It works as digital money within this blockchain platform. All transactions happens within this blockchain and being recorded on the central notebook, or so-called ledger. For example, a person named Star transferred $5 to another person named Wildflower, and a Wildflower transferred $10 to another person named Rosebush, and the Rosebush transfers $20 to a person named Money, and so on and so forth. All those transactions were recorded to the central ledger, and everyone in this blockchain holds a copy of this ledger, and they can see all the transactions. But the ledger can only be accessed by the account holders. And during this transaction, we do not know the identity of those account holders. In this system, any transaction can happen in seconds, even transfer to an account holder who lives in another country. There's no barrier as cross-region transaction since all the transactions happens in the blockchain. It is claimed that cryptocurrency has decentralization function, as no one knows the true identity or even the true name of Star, Wildflower, Rosebush, examples in our transaction, everyone in this blockchain. But in my opinion, that government officials are voting for the legalization of so-claimed decentralized cryptocurrency is a little funny. The current disadvantage with crypto money includes price volatility, lack of recoverability. For example, if you lose the password of your account, there's no way of recovery it. And there's also environmental concerns, security risks concerns like a cyber attack, fraud, and scams. So the cryptocurrency is still under developing. Though a lot of people strongly believe it is legitimate, there are still a lot of skeptics. For cryptocurrency to be commonly used, the people has to trust its value against the fiat money, then trust the fiat money's value against the government. So it requires a double level of trust, which also indicates a system of a double level of uncertainty. But Genius Act, which was signed by President Trump last week, is a positive sign of a good outlook for cryptocurrency. As a conclusion of today's video, money has a long history, evolving from simple exchanges to complex digital systems. It shows human adaptation to economic needs. From the original barter system, trading has transformed into today's complex global financial markets. For the future money, we may see further advancement in digital technology, and surely we will rely more on digital technologies, we will say. Thank you for joining my channel and staying with me in this video. I'll see you in my next video.